Hello and welcome back to our second lecture video dealing with Chapter 15, which talks about long-term liabilities. Specifically, we've been talking about nothing but bonds, okay? So the first video really went through the characteristics of bonds, some of the elements of bonds, things like the maturity date, the stated rate or the contractual interest rate. So it's very important that you understand that in order for us to be able to go ahead and prepare the journal entries whenever we first issue bonds or whenever we sell bonds, whenever we redeem bonds, right? We're going to have to see a journal entry, or we're going to have to know a journal entry on how we accrue interest. And then finally, we're going to have to know how do we do the journal entry to buy back bonds and also how to convert bonds into common stock. Okay, so it's very important that you recognize here that if a bondholder, right, that's me, right, or let me rephrase that, that's you guys, right? I'm the corporation. You buy bonds off of me. I issue bonds to you. I get cash. I'm going to owe you interest payments, and then at the end of the once the maturity date hits, I have to give you your principal amount back, the original amount that you invested. However, you as a bondholder, right, you invest in a bond, you can actually sell that bond to other investors, right? When this happens, me as the issuing company, I don't get any more money, right, on the transaction, right? When you sell a bond, me as the company, I don't have to do any journal entries of the transactions, okay? So when we're talking about calculating the bond price, buying back the bonds, selling the bonds, we're really talking about us, or me as the company, issuing to you as the bondholder. That's the first transaction. The second transaction, which could possibly happen, it could not happen. That second transaction revolves around the bondholders. If you want to hold the bond, great, you do nothing. You just sit back, collect the interest checks or interest payments, and wait to get your principal back. For some odd reason, and there are a number of reasons, or I shouldn't say odd reasons, but for a number of reasons, you as the bondholder might not want to hold my bond. That's okay. You have the option to sell it to somebody else, okay? So, who can I pick on? I'll pick on Miranda. Okay, so let's say Miranda's in our accounting class. She buys a bond off of me. She gets maybe a year or two's worth of interest. Miranda says, you know what? I really don't want to hold this bond anymore. I don't want to sit around and wait for my interest. I can go invest in something else and get a better return. What Miranda got to do is has to find somebody else to buy that bond off of her. So maybe she goes to my corp finance class and says, hey, I got a bond here paying 9% that Bruce issued to me. Anybody want to buy it? Hopefully somebody buys it. Me as the corporation, I don't get any cash from that transaction, right? I don't have to do any journal entries to record the fact that Miranda sold it to another student in another class, okay? So what we're going to be focusing on here are only the journal entries that the company has to do whenever they issue a bond, buy back a bond, accrue interest, which we've seen before, and the journal entries we need to make when you guys as bondholders convert to common stock, okay? So, first thing it's important to remember is the fact that we can issue a bond at 3 different prices, okay? We can issue a bond at the face value, which would be $1,000 per bond. We can offer it at a discount, which is less than $1,000, or we can issue it at a premium, which means more than $1,000, which is that face amount, okay? So it's very important that, first of all, you have this in your notes. If we issue a bond at the face value, we issue it for $1,000, what's the journal entry? The journal entry, make sure you have this in your notes, debit cash, credit bonds payable, okay? So whenever you do a journal entry and it says we issue a bond for face amount, right off the bat, you don't even need to think about it because you already memorized it. Debit cash, credit bonds payable, okay? Now, over time, or over the term of the bond, right, we have to book entries that require interest, right? We'll see how to, we've already seen how to do that, how to accrue interest, how to pay interest payable. Nothing new there, okay? However, at the maturity date, we need to record the final payment of interest, and we also need to record the payment of the face value of the bond. Okay? Oh, sorry. Very important. Okay? So now, we got to get to this idea, or we got to get back to bonds that are issued below or above face amount, right? If we issue a bond below face amount, we call that, we issue it at a discount. If we issue a bond above the face value, we say that's a premium. Now, how do we determine if it's a discount, a premium, or or we issue it at face amount? The key is to compare the bond contractual interest rate or the stated rate. I'm going to pay you 10%. Okay? It's stated. You're going to get 10% for giving me $1,000. Cool. We need to compare that rate with the market interest rate. Okay? You're going to want to write this down. The market interest rate, we can also call it the effective rate of interest. Okay? Or the effective rate. Those are synonyms for each other. Market interest rate, effective rate, they go hand in hand. Okay? Talking about the same thing. Now, if the market or the effective rate of interest is higher than the stated rate, the bond will sell at less than the face amount. So it'll sell at a discount. Excuse me. So what we're saying here is if the market rate is 12% and the stated rate is 10%, the bond will sell at a discount, meaning it will sell at less than its face value. Now, why? Think about it. Why? Well, here's why. I'm the bond issuer, all right? I'm the corporation, okay? What happens, bear with me here for a second. It's not working. Okay. This right here, when the market rate or the effective rate is higher than the contractual or the stated rate, we sell at a discount. Just put this in, okay? Think about it. Why? Well, I'm issuing bonds, right? I stated that I'm going to give you 10%, okay? You guys are savvy investors. You realize that you can give me $1,000 and earn a return of 10% because I'm paying you 10% on the face amount, or you can go find another investment or another bond that has a stated rate of 12%, okay? I need to entice you as investors to invest in my bond that's only paying 10% when the market is paying 12%. In order to do that, I need to lower the price of the bond, okay? Now, what if the bond rate or the contractual interest rate, the stated rate, is equaled to the market rate? Now, keep in mind, this is when it's issued, right? We're issuing a bond. We're going to state 10%. Then we look and say, what's the market going for? Market's 10%. That means we can sell our bond at the face amount, or we also call that par, the par value, okay? Either or, those are synonyms for each other. We can say face, we can say par. If we say par, we know it's $1,000. If we say the face value, we know it's $1,000 per bond, okay? Now, if the market rate of interest, okay, the effective rate is 8%, and that 8% or that market rate is lower than the stated rate or the contractual rate, we say that the bond will sell at a premium. I'm just going to abbreviate, say premium. Okay? Why? Well, that's easy, right? I'm offering 10%, right? The current market rate is 8%. A ton of people are going to want to come and buy my bond, right? Why? Because I'm paying a higher interest rate. My stated rate is higher than what the effective or the market rate is, okay? That will drive up demand for my bond. More people will want it. And in order for people to buy it, they're willing to pay a premium. They're willing to pay more money. And so instead of paying $1,000, maybe they'll pay $1,100 for this bond. They'll pay $1,100. Why? Because they're getting 2% more interest than what the market is yielding or what the market is paying. Okay. Very important you understand the difference, okay, between a premium, face or par, and discount. So definitely have that in your notes. Put that on a note card. It is imperative that you know that. Okay. Next thing we want to look at are kind of the journal entries, right? What are the journal entries? And you're definitely going to want to have this in your notes. If we issue a bond at a discount, what does that mean? That means the effective rate, also known as the market rate, is higher than the contractual interest rate, also called the stated rate. Okay, what do? Well, when we sell a bond at a discount, we have a new account we need to look at. This new account is called discount on bonds payable. Okay, it's a contra account, right? So here's the journal entry that you want to have for your notes. You want to debit discount on bonds payable. You want to debit cash, and then you credit bonds payable. Okay, and we're going to go through some examples of exactly how to do that. Okay, when bonds are sold at a premium, what does that mean? That means that the stated rate or the contractual interest rate on that bond is higher than the market interest rate or the effective rate. Okay, well, in this case, we have a new account. So whenever we're using or whenever we have an issuance at a premium, we need to credit a new account. This account is going to be called, wait for it, premium on bonds payable. Okay. And we're going to see when we report these that these contra asset accounts, whether it's a discount on bonds payable or a premium on bonds payable, those are reflected in the reporting of the bonds payable balance, right? Or the book value that we report those bonds on. Okay. So, real quick, just I'm not going to go through these questions, right? Asking about the market rate, have those in your notes, study those. Totally not a problem. Okay. So let's kind of look at, excuse me, what we need to do when we're issuing bonds at the face amount, right? January 1st, 2017, Candlestick Incorporated issues $10,000 5-year 10% bonds at 100, right? What does that 100 mean? That 100 means, or that number that's always going to be there, it's issued at whatever, it's a percentage of the face value. Okay, we're issuing it at 100. That means we're issuing that bond at 100% of its face value, right? What's the entry? Debit cash, credit bonds payable. Okay, if I were you, in my notes, I would say journal entry for issuing bonds at face value, debit cash, credit bonds payable. Okay. If we have to issue, let's say we're issuing a bond at face amount or face value, okay, we have periodic interest payments, right, that we have to make. This is we've seen this before. How do I journal that? Well, it's easy, right? Let's say that this 10% bond that we issued at face amount or 100% of face amount, we have to recognize the interest expense, right? How do we do that? Well, we debit interest expense, credit interest payable for $10,000. How did I get that $10,000? Well, I took 10% times the face amount. Okay. Okay. Issuing bonds at a discount, right? January 1st, 2017. Candlestick sells $10,000, 5-year, 10% bonds for $98,000, right? That means that it's selling for 98% of its face value, okay? Interest is payable annually on January 1st. The entry to record the issuance. So if I were you, in my notes, I would have issuing a bond at a discount. What do I have to do? Well, I debit cash for $98,000. I debit cash for the amount of cash I receive, right? If you're getting confused, ask yourself this question. How much cash am I getting? Well, I'm getting $98,000. Boom. That is what we record, okay? However much we're receiving in cash. Now, how much am I going to have to pay back when these bonds mature? Well, remember, it doesn't matter what price we sell them at. If we sell them at a premium, a discount, or par value, it doesn't matter. At the end of the maturity, or when the bond matures, we always have to record the amount that we're going to have to pay. We always pay the face amount, regardless of what we sell it at. I don't care if it's a premium, a discount, face value. We're always going to pay the face value when the bond matures, okay? So how much do I have to pay out 5 years from now? Well, based on today's dollars, or I'm sorry, don't even worry about present value yet, right? 5 years from now, I'm going to have to pay $100,000, right? I know that, okay? So I need to credit bonds payable for $100,000. The difference between the cash that I receive in the bonds payable that I book, that difference is $2,000 in this example. That is a discount on bonds premium. So I need to debit my discount on bonds premium account, okay? Or I'm sorry, discount on bonds payable account. That is for a discount, right? Remember that discount on bonds payable, it's a contra asset account, right? It goes against the bonds payable. So think about it. What's the value of my bonds payable account right now? Well, it's $98,000. How'd you get that? My bonds payable is $100,000. Underneath it, also included in that bonds payable is the fact that I issued it at a discount of $2,000. So I need to subtract out the $2,000, that discount on bonds payable, from my bonds payable account. I'm going to report $98,000. Okay, and here's exactly how it looks on the slide or in the balance sheet. Long-term liabilities, bonds payable $100,000 less discount on bonds payable $2,000. The balance is $98,000. Okay. Now, keep in mind that this is when we sell bonds below the face value, the discount. What does that mean? That means that the total cost of borrowing is greater than the interest paid. Okay. Why? Well, again, it has to deal with the borrower requiring a return, right? So the borrower's the borrower is required to pay the bond discount at maturity date, right? So that means instead of paying, I got in $98,000 in cash, but at maturity, I got to pay $100,000. That bond discount is what we consider a cost in borrowing, okay? And it actually increases. It's an increase in the cost of borrowing, okay? So let's look at issuing a bond at a premium, right? What's the journal entry? Well, right off the bat in your notes, when I issue a bond at premium, I have to memorize, I have to know without even thinking about it. Debit cash for the amount of cash I receive. I credit bonds payable for the amount of, or for the face amount of the bonds. And then I have to credit premium on bonds payable. That's $2,000, right? Now, let's look at the example. January 1st, 2017, Candlestick sells 100,000, 5-year, 10% bonds. They sell them for $102 or $102,000. That means it's 102% of the face value. Okay? Interest is paid annually. We got to record the entry. Again, debit cash for the amount of cash that I receive, $102,000. Bonds payable, That's going to be the face amount, because I know at some point in time, 5 years from now, I'm going to have to pay $10,000 to those bondholders to retire those bonds. The difference is going to be the premium on bonds payable. Okay? Think about it this way. The premium on bonds payable, again, it's a contra asset account. It increases with a credit. So I'm increasing that premium, right? How do we report it? Well, in the statement, and you got to know this, right? In the statement, we have our bonds payable, $100,000, and then we need to add the premium on bonds payable, which is $2,000. So what's the total value of bonds payable? Well, in this case, it's $102,000. Now, if we sell a bond at a premium, the total cost of borrowing is going to be less than the interest paid. How does that work? Well, or why? The reason is because borrowers are not required to pay the bond premium at the maturity date, right? Not required to pay that. So the bond premium is considered to be a reduction in the cost of borrowing. So we have an example here of two journal entries. I'm not going to waste time really going through these. The reason why is we're going to work on some examples. Now, when we redeem bonds before the maturity, right? Why would we do that, right? Remember, if a bond is callable, and a lot of bonds have that callable feature, okay? I, as the corporation, reserve the right to call back that bond. That means that I'm going to pay you your face value, and I'm going to give you a little premium for that, because guess what happens? You're not going to be able to collect the interest payments. I'm stopping that payment of interest, okay? So, why would a company do this? Well, they want to eliminate the carrying value of the bonds at the redemption date, right? What does that mean? Eliminating carrying value of bonds at redemption date. Well, that's an example of serial bonds, right? We call them due in increments, okay? We got to record cash being paid, and then we have to recognize, do we have a gain or loss on that redemption, okay? When we're looking at the carrying value of the bond, right? That is the face value of the bond less any discount or plus any bond premium at the redemption date. That is just another way of saying, if I have a premium, I need to add it to the bonds payable. If I have a discount, I need to subtract it from the balance in the bonds payable. Okay, that's really all that's saying. Okay. Okay, so let's just look at a quick illustration, right? Let's say, for example, that Candlestick has sold its bonds at a premium. We did that before, right? At the end of the fourth period, Candlestick retires these bonds at 103% after paying annual interest, right? The carrying value of the bonds at the redemption date is $100,004, okay? Or $100,400. Candlesticks makes the following entry at the redemption at the end of the fourth interest payment, okay? So, this might look confusing. It's not. Just ask yourself, what did I get? What did I have to give? That's it, right? We know we're paying 103 after that interest payment. So how much cash am I paying? $103,000, right? Okay. What are my bonds payable? Well, they're on the books at $100,000. So I need to debit bonds payable for $100,000, credit cash for $103,000. Okay. They tell us that the carrying value of the bonds is $1,400. That means that the accounts payable is $100,000. That $400, that's the premium on bonds payable, right? I'm redeeming the bonds before maturity. I need to get rid of that premium on bonds payable, so I debit it, right? Then I need to calculate, did I have a loss on bond redemption? Yep, sure did, right? I paid out $103,000. My books say I should have paid out $100,400. The difference, that's the $2,600. That's the loss on the bond redemption. Okay? Converting, right? Converting to common stock. Pretty easy to do, right? Keep in mind that once the bondholder, and again, this is the right of the investor or the bondholder to convert, until that conversion happens, the bondholders or you guys are going to receive interest on the bond, right? Again, me as the issuer, the bond is going to sell at a higher price and it's going to pay a lower interest rate than comparable debt securities, right? Why? Well, because I have to pay, there's going to be a premium there for that conversion rate, okay? So keep in mind that the price, or if a bond has a convertible option to it, it is always going to be a higher price at a lower interest rate, okay? What happens on conversion? Well, on conversion, guess what? We transfer the carrying value of the bonds to our paid-in capital account. Whenever we're converting bonds, we do not recognize any gains or losses. Okay, let's look at an example. July 1st, Saunders Associates converts a $100,000 bond sold at face value into 2,000 shares of $10 par value common stock. Both the bonds and the common stock have a market value of $130,000. What journal entry do we have to make? Well, let's think about this, right? Bonds payable go away, right? So we had $100,000 in bonds payable. We need to debit that to decrease that bonds payable, to eliminate that bonds payable. We hit common stock for the par value, so 2,000 times $10 gives me the 20,000. That's the numbers of shares times the par value, the difference, right? We see that there's an $80,000 difference within this journal entry. That's the paid-in capital in excess of par common stock. Okay? We're going to work through some examples, but when we come back, we're going to work through a number of exercises demonstrating how exactly do we or getting practice recording these entries, right? So just to let you know, we're going to work on exercise 5-2 and 5-3 and 5-4. Yeah, we'll do 3 examples. So 5-2, 5-3, and exercise 5-4. If I were you, based on the notes that you took from this and your understanding, try the problem first. Then come back, watch the demo video where we go through the journal entries, and that way you'll be able to identify where you went wrong, hopefully, or you'll be able to reinforce what you did right. And if you're confused after all this, you know how to get a hold of me. I'd love to, work through it with you. So tune back in for, or actually go try those 3 exercises and then come back and watch the demo video. Thanks, and we'll see you in a bit.